All right, let's jump right into today's explainer. If you're looking for clear, direct, and structured insights into high-yield strategies, you are exactly in the right place. Today, we're analyzing a heavyweight matchup between two tech-focused income titans, KQQ and QDVO. Now, both of these are actively managed, both leverage the world's most powerful tech companies, and both use covered call strategies to generate monthly income. But as you're going to see, the way they get there and the actual results they deliver are incredibly different. You know the dilemma. We all hit this crossroad eventually. Every single income investor faces this exact same fundamental trade-off. Do you chase that higher yield right now, knowing you might risk giving up long-term upside? Or do you settle for a lower yield today, just trusting that a better total return is going to make up the difference over the long run? Usually, this trade-off is just, well, it's abstract. It lives in those theoretical spreadsheets comparing asset classes that are honestly just too different from one another to make the choice feel concrete. But today, we're taking it out of the spreadsheet. This abstract choice is becoming very real. We're looking at two genuinely well-constructed vehicles that tackle this exact dilemma from completely opposite angles. So here's our roadmap for the explainer. We'll start with the yield versus growth dilemma, move on to KQQQ's volatility play, check out QDVO's tactical dividend growth, put their outcomes head-to-head, and finally figure out which one actually fits your portfolio. Section 1. The yield versus growth dilemma. To really get this, we have to recognize that a lot of times, comparisons in the income space pit some poorly constructed, overly hyped high-yield fund against a safe, lower-yield fund. But that's not what we're doing. This isn't a comparison between a good fund and a bad fund. Both of these are fantastic, thoughtfully constructed tools. What we have here is a clash of two very different investing philosophies, maximizing your current income versus balancing that income with capital appreciation. Section 2. KQQ Volatility for Maximum Income. Let's meet contender number 1. You can think of this one as the yield engine. The Curve Technology Titan Select ETF, or KQQ, has only been trading since mid-2024, but man, it is making serious waves. It doesn't want to just lazily mirror a broad tech index. Instead, the managers are making highly concentrated bets on high-conviction tech titans. We're talking companies like Google, Amazon, Broadcom. These are firms sitting right at the intersection of huge long-term growth and high day-to-day price movement. And that hyper-focus, it's generating a massive current distribution rate of 17%. So why target those specific companies? Well, for KQQQ, volatility is a feature, not a bug. It's literally the whole point. Higher volatility means they can harvest much higher option premiums when they write covered calls. But here's what makes KQQQ truly compelling, especially for taxable accounts. It's tax efficiency. It's structurally designed to classify a huge chunk of that 17% yield as return of capital. Essentially, you're getting your own money back, which defers your taxes until you actually sell the fund. That makes the after-tax value here highly attractive compared to a fund paying standard ordinary income. Section 3. QDVO, Tactical Dividend Growth. All right, let's meet our second contender. If KQQQ is the yield engine, QDVO is the growth defender. The Amplify CWP Growth and Income ETF has a much longer, more established track record, and its objective is totally inverted compared to typical income funds. It explicitly prioritizes capital appreciation first and high current income second. It's built on large-cap dividend growth stalwarts, think NVIDIA, Apple, Google, and it offers a more conservative, but honestly still very healthy, distribution rate of 11%. Now pay attention to the word tactical here. QDVO uses a tactical covered call strategy rather than a systematic automated one. This means there isn't some robot writing calls blindly. The managers are actively at the wheel, deciding exactly when and how to write these calls based on real-time market conditions. For example, if they think NVIDIA is about to go on an absolute tear, they might write fewer calls or write them way further out of the money, deliberately preserving the stock's upside potential. Section 4. The Outcomes Head-to-Head. Let's see what happens when these concepts collide. Okay, so we've got the underlying mechanics down. On one side, we have QQQ squeezing every possible dollar of option premium out of highly volatile tech titans. On the other side, we have QDVO playing defense to preserve growth by writing tactical calls on dividend-paying stalwarts. Let's see what actually happens to the total return. Check this out. Over the comparable trading period, QVDO has delivered roughly 32% in total return, compared to 25% for KQQ.
That is a massive 7 percentage point advantage for QVDO. It basically proves that by prioritizing growth and tactically preserving upside during tech rallies, QVDO's philosophy of total return over pure yield has historically paid off. But hold on a second. Total return is only half the story, right? Because if you're an income investor actually living off your portfolio, total return doesn't pay the monthly utility bill. You can't buy groceries with unrealized gains. You need cash in hand. And that brings us to a very, very important number.
Look at what happens if we're talking about a $200,000 nest egg. KQQ's 17% yield hands you approximately $28,000 a year in distributions. QDVO, that gives you about $22,000. That is a $6,000 difference in cold, hard, tangible, spendable cash. For a retiree or just someone using these distributions to cover living expenses, $6,000 is absolutely huge. You literally can't dismiss KQQ just because its total return is slightly lower. It is doing exactly what it was built to do: generate maximum current income.
Section 5. So, which one fits your portfolio?
It's a split decision, right? One clearly wins on total return, the other clearly wins on current cash flow. So how do we resolve this dilemma for your actual life? Well, it all boils down to the phase of your investing journey. If you're in the accumulation phase, meaning you're reinvesting your dividends, total return is what grows your wealth over time. QVVO is hands down your best fit. But if you're in the distribution phase, needing maximum cash flow right now for your daily life, KQQ is practically tailor-made for you. And hey, if you're somewhere in the middle, maybe spending some and reinvesting some, you can totally hold both in a custom ratio that fits your specific blended lifestyle. Okay, reality check before you hit the buy button. We need to talk about risk. Both of these funds are heavily, heavily concentrated in the tech sector. If tech suffers a sustained bear market, both of these are going to face heavy drawdowns. No way around it. QDVO's large cap dividend stocks do offer a bit more financial resilience, whereas KQQQ's high volatility titans are definitely more susceptible to sharp sentiment-driven sell-offs. Also, keep track record length in mind. QDVO has been battle-tested across varying conditions. KQQQ, it's only existed in a mostly favorable tech environment since mid-2024. So make sure you size your positions accordingly.
And honestly, this brilliantly illustrates exactly how you should be integrating these funds. Please do not make KQQQ or QDVO your entire portfolio. They are absolutely not substitutes for broad market index funds. Your core stability should come from broad, index-based covered call ETFs, things like SPII or QQQI. You then add KQQQ or QDVO as concentrated satellite positions. Your core provides the diversification and stability, while your satellite tech positions turbocharge your income or your growth. It's like a giant puzzle, and these are just corner pieces. Ultimately, the choice between them isn't about which one is inherently better. It's about which one actually aligns with what you need your money to do for you right now. So I've got a question for you. Which phase of the investor journey are you currently in? Are you prioritizing total return with QDVO, or are you going for maximum current income with KQQ? Drop a comment below and let me know how you're navigating this trade-off. We genuinely read every single comment. If this explainer brought some clarity to your strategy, make sure to apply these structured insights to your own portfolio. Keep learning, stay focused, and we'll see you at the next one.